G'day and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's check where we finished on Friday. Investors were buoyed by lower inflation data and the beginning of US third quarter earnings season. Strong quarterly results from the banks helped the S&P 500 and Dow to new record highs on Wall Street. For the week, the S&P and Nasdaq added 1.1% and the Dow was up 1.2%, their fifth weekly gain in a row. Shares in JPMorgan, the largest US bank, rallied after the third quarter profit beat expectations on strong investment banking performance and rising interest payments, which offset bigger loan loss provisions. Wells Fargo rose strongly as it surpassed profit estimates after setting aside less money than expected to cover potential loan losses and predicted its interest income would improve. And BlackRock gained after the asset manager reported that its assets under management had hit a record high for the third straight quarter. And the results saw the S&P 500 Banks Index add 4.2%, taking it to its highest level since February 2022. Elsewhere, Tesla's shares reversed sharply after the EV maker unveiled its long-awaited robo-taxi but did not provide details on how fast it could ramp up production or deal with potential regulatory hurdles. And that saw shares in Uber and Lyft surge as investor disappointment over Tesla's robo-taxi event eased competition fears. And ahead this week, we will get earnings from American Express, Netflix, United Airlines, Procter & Gamble and several of the major banks, giving us a further pulse of US consumer spending. Well, US producer prices were unchanged in September following an unrevised 0.2% gain in August, with higher food costs the biggest contributor. In the 12 months through to September, the producer price index increased 1.8%. The US Treasury yield slid on Friday as markets priced in a near certainty of a Fed cut in November, the 10-year falling to 4.07% and the 2-year down more than 5 basis points to 3.94%. Elsewhere, Britain's economy grew in August after 2 consecutive months of stagnation, with economic output rising 0.2% in monthly terms. And China's consumer market stayed steady in September, with the consumer price index rising 0.4% year on year. Meanwhile, China's finance ministry failed to unveil further concrete additional stimulus measures on Saturday, although there is another briefing today, which is expected to focus on market support measures. And Goldman Sachs now believes China will achieve its 2024 growth target of around 5%, following that latest round of stimulus. Well, the absence of further announcements overnight, over the weekend, I should say, from China, could put downward pressure on the Aussie. It's currently at 67.3 US cents. The US dollar largely flat against most major currencies on Friday. Taking a look at commodities, oil prices eased on Friday, but were up for the week as investors weighed factors such as possible supply disruptions in the Middle East and Hurricane Milton's impact on US fuel demand. Brent crude futures at $79 a barrel. Metals were up across the board. Iron ore 1.5% higher at $105 a tonne, and gold rose more than 1% as US inflation data reaffirmed the likelihood of another interest rate cut next month. Spot gold at $2,655 an ounce. And Bitcoin rallied over the weekend to over $62,500 US. All right, let's get some perspective now of what we're seeing on global markets. Greg Smith joining us from Devon Funds Management. Greg, welcome back on this Monday morning as we begin a new week. How have you begun over there?
Hi, Andrew. Good morning. Great to be back. So we're up open a touch softer. So the NZX 50 over here had a good week last week. We're up 1.8%. We had that rate cut, which we talked about on ausbiz last week. So that was 50 basis points. That was positively received. But NZX 50 is down 0.4% at the moment. So a little bit of disappointment, I suppose, shared with there as well over the announcement from China over the weekend. Obviously a big customer to New Zealand as well. So yeah, a bit of a mixed performance. We've got airport trading lower. We've got quite a few large caps a touch softer. A2 Milk's down 1.4%. See China a big customer there. So yeah, a bit of a soft start to the week.
More globally, and I guess particularly what we're seeing on Wall Street at the moment, would you expect that market to grind higher? Obviously, we're heading into the November election. That's about 3 weeks or so away, so it's getting close. But of course, now we have got earnings season underway, and that was a good start as far as those banks we heard.
Yeah, it was a very good start, wasn't it? From the biggest bank in America, or indeed the biggest bank in the world in terms of JPMorgan Chase, and a very big bank as well in terms of Wells Fargo. So we've got four more big banks reporting this week. So as is always, they tend to start the earnings season, tends to be a lot sort of riding on them in terms of the economic barometers and the like. But of course, this time around, with the Fed has started that rate easing journey. But yeah, the message from JP Morgan Chase was that they're still going to do pretty well in the year ahead if you look at in terms of net interest margins, not so much for 2025. And I suppose rates aren't, by the looks of things, going back to sort of those COVID levels. So, but yeah, in terms of the earnings season, it's going to be quite important, as it always is. The outlook statements, as you point out, the election. It's early next month. We can expect a bit of volatility around there. But yeah, the reality is the S&P 500 record highs, up over 20% this year. The Dow record highs. Nasdaq not too far away as well. So markets have had a really good run this year. There's been pockets of volatility from time to time, but generally it's been a pretty strong performance by markets. So if anything untoward in the earnings season would probably be digested, as long as it isn't across the board. So yeah, quite important week, as I say, with those four big banks. We've also got three big healthcare names. We've got Netflix, we've got American Express. That's always a bit of a barometer as well. And of course, data that comes out generally. We've got retail sales. It was quite nice to end that week with a better than expected inflation print, with the wholesale inflation numbers after CPI came in a touch higher. So I think markets are basically saying we're going to get a rate cut just after the election. It's going to probably be in the order of 0.25% at this stage.
Markets seem to be running counter to seasonality, because traditionally this time of year it's quite weak, isn't it?
Yeah, that's right. Yeah, so September they talk about being a bit of a bull killer historically, and September sort of came to pass. It was a bit of a wobble at the start of the month, as there was in August actually as well, and October. So I guess, look, we've only got 12 months a year, so it's easy to make a trend a little bit, isn't it? Really, but I think the earnings season will play a big part in that. We obviously have got developments in the Middle East. So oil was a touch softer on Friday. So I think that'll be important. Anything left field, of course, is always very relevant. But a lot hanging on the earnings season. It'll be interesting to see, as we get closer to that election, whether that starts to play a part. But what I would say as well, I suppose playing devil's advocate, is the soft economic landing is effectively being priced in. So anything that disrupts that, could potentially have an impact in October. But a good earnings season. If they're prepared to cut another 25 basis points, will be relevant. But I suppose a Trump presidency potentially being inflationary might be a bit more relevant as election day approaches. But October looks like it's poised for a reasonable start, at least anyway.
So focus there on New Zealand, Greg. Of course, you got your rate cut last week, a sizable 50 point, although you were arguing they perhaps needed to go 75. What are you seeing there at the moment, the reasons why, given, I guess, overall how the Kiwi economy is tracking?
Yeah, that's right. We discussed at the time. I mean, basically, I don't think they were ever going to do 75, but we're basically saying there was a logic to that. And look, the economy is in a pretty tough spot. Our central bank goes on holiday for the best part of 3 months, from December through to late February, and we're in a much worse shape than America and even Australia. So we've had a manufacturing printout on Friday, so that showed we're in contraction mode in terms of that key sector. And we've had the services print out this morning as well. Same deal. We've got a reading of the PSI for September of 45.7, so below 50 is in contraction mode, and the report was titled same. So the services sector, which has obviously been strong in a lot of countries, has been in contraction for 7 consecutive months. Employment index, it's the lowest result since February 2022. New orders, that's stagnating as well. The only bright point is that proportion of negative comments has declined, but it's still 58.5%. So it's certainly not the rate cut that we got last week is certainly not going to be a magic bullet. We need sort of further stimulus. We need another 50 basis point cut minimum next month. And we've got the service sector. We've got unemployment. It's probably north of 5%. And I guess the whole point about that case last week, just to remind, was that the RBNZ's sole mandate is price stability. Now, they've effectively acknowledged that inflation is within their band of 1 to 3%, potentially near the midpoint. Their neutral rate is 3.8%. So at 4.75, we're still almost a percent higher. The interesting one, Andrew, this week is going to be our long-awaited quarterly inflation prints. We're not fortunate enough to get monthly prints like Australia. We have to wait a while. So that will be interesting to see what that says. We're expecting inflation to drop below 3%. So we're into the RBNZ band, yet they're still at this rate, which is above neutral. So meanwhile, the economy, for want of a better word, is cratering in places.
Indeed. Hey, very quickly, you've also had news out this morning from TPG Telecom, locally at least, that's selling its fixed fibre network. What did you make of that?
Yeah, so look, plenty going on in the telco sector. I suppose, ultimately the pricing multiple looks okay. It'll be interesting to see how the shares react. It's less than 18% of their revenue, so they're not sort of giving the sort of the golden gate away type thing. But obviously that's going to provide them with growth capital. Let's say the multiple looks pretty reasonable. Obviously, there's lots of activity in the telco space, jostling for position and whatnot. Obviously that deal with Telstra was blocked. It looks on the face of it like a good deal, but lots of movement in the telco space globally.
Greg, great to get across what you're seeing in the markets at the moment. Thanks for joining us from Devon Funds Management.
Have a great week. Bye for now.
Cheers. All right, a quick check of where we're likely to get underway. Looking positive. More than 0.5% higher on SPI futures. We're going to get right across it all when we get going in just a couple of minutes' time.